Hi everyone, it's Lisa Hoover, and today our topic is going to be how market changes impact home prices. I think that this is extremely important. So in this video, we're going to discuss how the recent shifts in the real estate market can affect your property values, and how we're going to cover topics like interest rates, the rising and falling of them, the changes in the local inventory that exist in the real estate market. We're going to talk about broader economic trends that influence home prices, right? And here's the thing, whether you're planning to buy or to sell, understanding how these changes can help you make the right decision at the right time, I believe is important and crucial, right? And toward the end, we'll give a few examples, what I think of how the past market have impacted home prices, to give you a clearer understanding of what to expect as we move forward, right? So what did I want to give you an overview of what the agenda will be. And so, yes, we're going to talk about interest rates, as I said. We're going to talk about inventory changes. We're going to talk about buyer demand, one of my favorites. We're going to talk about economic trends and what that means and the impact that it has for you and home prices. And then we're going to look at a couple of case studies to kind of talk about the impact that those conditions or situations had on the home prices. Okay, so let's get started. All right. So as I told you, the first thing that we're going to talk about is we're going to talk about interest rates. Let's talk about it, right? When we're talking about interest rates, the thing that's so important to know about interest rates is this, right? Whether they're rising or whether they're falling. So they affect home prices. And they affect affordability. That's the most important thing about interest rates, right? Interest rates affect your ability to purchase a home, your purchasing power, how much power you have to or how much house you can afford, basically, and affordability, right? So think about it this way. So when the interest rates were 3%, a house that was 300,000, maybe now at 3% interest rate, you can afford a house that's maybe 415, 410, right? So you have much more purchasing power or ability to purchase more, right? It becomes more affordable for you to purchase that home at that price because the interest rates are low enough, right? And they can make things more affordable. So your monthly mortgage payment is going to be lower automatically, right? And so that's just how you need to kind of think about it. Lower mortgage costs, increases affordability, right? And buyer competition, which can then turn around and drive things up, right? Because we know that when the interest rate were 3% or 3.5% or 4%, people were flocking into the market because now they can finally get into the market, right? And so as a result, some of the prices did go higher during that time. So let's talk about when the interest rates are higher, right? So when interest rates are higher, that means your mortgage cost is going to increase. What happens as a result of that? It reduces affordability, and as a result, it reduces demand, because if you can't afford it, then you're looking at something different. Case in point, let's use this same example. We have a house that's on the market. It's for sale. And now instead of 3.5%, it's now interest rate is 6%. Okay, remember that house that you could have now got for 415? Well, now you can maybe only get a house that's maybe 280, 290, right? So it could be that type of variance, that type of stark contrast, all because of the interest rate. So remember, higher interest rate increases your mortgage costs. It reduces your affordability and the demand, right? If the interest rates are lower, then guess what? You have more purchasing power. It increases your affordability, and it will also, as a result, as we know, increase demand because more people are going to get into the market. All right, so that's what we have to say about interest rate. The next thing we're going to kind of look at is the inventory. And this is what I need you to get really. Inventory determines which market we're going to be in. Yay! So I think that's important because a lot of people don't understand that. The inventory determines whether you're in a buyer's market or if you're in a seller's market, all right? So when you're in a buyer's market, automatically, and we haven't been in one in a long time, right? That means there's higher inventory, meaning there are more homes that are available, right? So you, instead of having 10 homes to choose from, guess what? Those same group of buyers may now at this point have 40 homes to choose from. What happens as a result of that? Buyers now have negotiation power, right? And that leads to lower prices, right? Because the seller still wants to sell their home, but now, you know, they have some options because it's not just one buyer, it's a plethora of buyers. And so buyers have a little bit more negotiating power, right? What about prices that tend to stabilize? They do that as a result when there is a high inventory, right? And let me just clarify something if I misspoke. When you have higher inventory, buyers do have more negotiating power, and it does lead to lower prices. Why? Because if the buyer can just move on to the next house, right? Because instead of 10, you now have 40, then that gives the buyer the opportunity to negotiate and to possibly get a lower price. Doesn't mean you always will, but it does have that potential, right? Prices tend to stabilize and they increase because now you have such a high supply. So then it begins to normal out, is what I always tell my clients. Waiting for the market to kind of normalize a little bit, right? Do I think housing prices are going to plummet? No, because housing value is high. I just think that it begins to normalize. Okay, so when we're in a buyer's market, right? So now let's talk about the seller market, which is where we've been for quite some time, to be quite honest, right? In a seller's market, we have low inventory, as you all know. That means there are less homes that are available. So using that same example, instead of 40 houses, we only have 10 houses that's on the market, and we have 50 buyers. So they're all vying for that same house. And typically what I've learned in all my years in doing this is that people tend to be within the same bracket looking for the same type of thing. So if there's a sweet spot price point, most often than not, there are a lot of people that are going to be in that same sweet spot. Got it? All right. When you're in a seller's market, that means they have more negotiating power, which often leads to higher prices. We actually saw this right after the pandemic, quote unquote, right? And that was that you had 10 people bidding on one home. And so the seller was like, okay, well, then you may need to up your price because this person has bid X, Y, and Z. And so the price does tend to go higher, right? Prices tend to increase when there is a high demand and low supply. When we're talking about inventory, it's all about what market are you in, and it's simple economics, supply and demand. Got it? All right. So that's kind of like my favorite thing to talk about, all right? The next thing that we're going to kind of touch on is the buyer demand. And to me, this is extremely important because not the industry, I say all the time that the buyer is the principal, the engine that drives this industry in the real estate market, right? It drives home prices, but it definitely drives the real estate industry. Buyers do that, okay? So what are the things that affect whether the buyers demand? Well, one of the things that we realized that became like an explosion was remote work. Yeah, there were people that were doing remote work, but let me tell you, after the pandemic or during the pandemic, the number has grown exponentially. What happens as a result of that? People want to come out of and they want to go into the suburbs because they want a little bit more space, right? And they want to be able to go outside. So in case the pandemic ever happens or something like that happens again, they have the ability to not kind of stuck or confined to small spaces. And they want to be able to do what? Have the ability to have space in their home where they can do a work. So everybody wants a flex space or office space that they can utilize, right? So that was one trend that was actually happening all over the place, right? And then there was lifestyle changes. And what do I mean by that? Well, maybe there's been an addition to the family or two, or maybe you've had to downsize, right? Because, the kids have gone off to college, or maybe you got a new job, right? The other thing is that with regard to lifestyle changes, maybe elderly parent now has to come and live with you. So all of those things impact. And let me just go back to remote working trends for a second. The biggest benefit for remote working trends is this. People all of a sudden, if they wanted to live in a certain place because they were remote working, they now, for the first time, had the freedom and the opportunity to do that. So in places that were a little bit warmer, you saw an explosion in the housing market because people felt like, wow, I can now live where in a warmer climate because guess what? I can work from home. All right. So I want to make sure that we kind of talked about that. But lifestyle change is a huge impact on buyers' demand because things are always happening in our lives. And the other thing is economic confidence. When we feel a little bit more confident about that, the bottom's not going to fall out. Guess what? We will high ticket items like cars and homes and stuff like that. And so economic confidence or believing that the market is not going to just crash on you or the bottom's not going to fall out is extremely, extremely important, right? So just know that, right? And then there's interest rates. You guys know that I have talked about this ad nauseum. We just kind of talked about it. Interest rate increases your purchase power or decreases your purchasing power. So just so that you know that. And then there's the market sentiment. And this is what I call sometimes market fatigue. And what I mean by that is for the last year or so, right? Maybe a little bit, maybe about 14 months, we have been waiting for things to happen with the interest rate. And every time we get closer, is this going to happen? It didn't happen. We expected there to be a decrease in the interest rate, that the Feds would do a decrease. Well, I call that economic fatigue because we kept getting and waiting and anticipating, and it didn't happen, right? And so that leads to either a positive market sentiment or a very negative market sentiment, or sometimes it's just neutral, and people are like, I don't have much to say. I've been waiting for this. It may never happen, and I'm not coming into the market until it does, all right? And so I think that that's important for us to just know and kind of be aware that market sentiment plays a huge role in the demand for buyers. All righty. Next is economic trends. Like, this is the one where we just kind of talk about it because it's really a national thing that's going to impact us in our individual communities. So it's just knowing that is important. So when we talk about economic trends, what we're actually really talking about is like employment rates, right? They impact whether or not people have the ability to purchase. If the unemployment rate is high, then guess what? You're going to have a lot harder time getting people qualified and getting people with the ability to have the income and the assets as far as cash flow in order to be able to purchase a home, right? So it's going to affect home prices, right? It definitely will. The other thing is inflation, right? And here's what I'll say about inflation. It is something that exists, right? The important thing is for the government or the apparatus that kind of, corrals the inflation rate needs to make sure that it's operating so that we don't get to a point where the consumer confidence is zero, which is what happened just before the Great Depression, right? You saw it going in a certain trajectory and nobody did anything to slow it down, and then all of a sudden consumer confidence was zero because, hey, the market had crashed and people really didn't know what to do, right? And it was just a lot of there was a lot of negativity. So when people hear the word inflation, they often, especially if you have older people in your family, they often tie it to that time in life. And so it has a negative connotation. And it is. I'm not saying that it isn't. But just understand that inflation is a normal part of our economic system process. Okay? All right. And then there's these two case studies. So let's kind of talk about them right quick if we can. So the first one, these are kind of the obstacles that you may kind of encounter if you have this situation. So in 2008, everybody knows about the housing market crash, right? As a result of that crash, there was a sharp decline. I mean, things fell out of the bottom of home prices, right? And there was increased foreclosures, and it was just pure craziness was going on because this had never really happened before. And the housing market crash led to a significant drop in home prices across the country, right? Like the bottom literally fell out of what people thought their homes were valued at, right? And as a result, people were beginning to lose their home. And guess what? That meant the unemployment rate went up, right? And so some of the things that came out of that is that they started to tighten the credit availability and tighten the credit structure and permissions and factors that they needed for when people were purchasing homes. And the demand by buyers was next to zero, right? Because they just couldn't believe that a house that they had been appraised at over 100,000 more than what they thought it was worth, or what they purchased it for, now was worth even less than that. And so a lot of things happened as a result of that. A lot of changes. One of them was with appraisals, but it was also about making sure that people could afford the homes that they were buying, right? You know what we saw during 2008, 2009, even up to 2010. There was a lot of foreclosures. There were a lot of empty houses. People kind of walked away, and there was just like mad chaos, right? They put a lot of things into place, and a lot of people felt like right after COVID, which is the next case that we're going to talk about, that thought that would happen all over again. But they had put structures and roadblocks and things in place so that would not happen. All right. And then there's the next one, which is, we all know, we lived through it, 2020, COVID-19, right? The pandemic. So just before the pandemic, there were low interest rates, right? And what happened as a result of the pandemic is there was a change in the work environment, like we've kind of already talked about, right? And what happened in that work environment was simply this, and that is that people were able to now move and go where they really might want to hang out and live and play at. And so, because they could now work from home. And so that led to a higher buyer demand, right? You had the benefit of the low interest rate and the high buyer demand. But guess what? There wasn't a lot of inventory, right? Because other people that were in their homes kind of stayed in their homes, right? And most often the people that were selling, they were selling to move to some place where they could be outside all the time, because that seemed to be a significant thing. So just think about those obstacles within this industry that may affect your home price, okay? So if you want to know more, you can email me, or you can, hit me up, and I assure you that I will, respond to you. And you can always call me 433834808. I look forward to talking to you when you call. If you have any questions, just let me know, right? I want to be a source of information for you so you can make the best decision for yourself. All right. So let's talk about some takeaways, because I'm a firm believer, like, knowledge is power, right? That is like kind of how I've lived my life. And the more information you know, the better decision that you make. And when you make that decision, you're going to know when that decision is right for you at the right time. But these factors that we kind of talked about, like these key points, they play into you making that informed and right decision at the right time. Our interest rates, because they're going to impact your affordability. What are the interest rates? What do they look like? What does the inventory look like? Am I in a buyer's market, or am I in a seller's market? Right? Economics always plays a role, right? It does, because am I going to have the funding that I need? So that's employment plays a role. So economic factors, inflation, consumer confidence, all of those things, all those economic trends matter. Got it? So what are the actionable takeaways I really want you guys to consider I want you to be staying informed? I want you to monitor the interest rate and decide when is the best time for you to buy. That doesn't mean that you check the interest rates every day or every week, but just kind of keep your eye on it. You get to see trends that are happening, right? And you can see some trends happening if you just kind of watch the interest rates as it rises and falls, right? So finally, we should be on a downward trajectory for the interest rate, which is what I told you, the fatigue we were experiencing, because we kept waiting for it to happen, right? But it's starting to happen. So just kind of keep your eye on that. Here's what I will say about the interest rate, though. I've told this to my clients. Everyone says, well, I want to get back to 3%. The 3%, that's once in a lifetime, right? That's not going to happen anytime soon. But once you get the interest rate to a level where you've spoken to a lender and you've talked over the numbers where you're comfortable, make sure that it's affordable for you so that you can still have a lifestyle or enjoy the things you want to do. Pay attention to inventory levels, not necessarily on the national scale, right? When they're talking about, oh, there's a housing boom, look at what's happening in your neighborhood or in your county, because even statewide, it's going to be different in every county. But see, our industries coming into that area. Are they building new construction? Well, they wouldn't just be building new construction for no reason. They're building new constructions because industries coming in. Maybe they have entertainment or shops and restaurants and that kind of thing coming into the area. So kind of pay attention to the inventory that's happening in the areas that you want to be in, as well as the area that you may not even live in. And keep your eye and knowledge about all these economic factors that we've already talked about. I mean, I think that it's important that people understand just how all of these factors play a role with the housing price, right? So let me kind of leave you with this. If you understand how these factors work, that gives you confidence. When you have confidence, you can make what I consider to be an informed decision. Everybody has the opportunity to live and obtain the American dream of home ownership. Okay. If you have any questions, you can reach out and talk to you soon. Be well.